Okay, let's kick off now. So good morning again, and welcome to Saxo's weekly market outlook call. I'm Charu Chanana. I'm a market strategist with Saxo Singapore, and I'm joined today by my colleague Redmond Wong. He's from our Saxo Hong Kong office. We have this really pivotal week ahead of us today, and but before we dig into what to watch this week, let's start with the big picture first, very briefly. So what's happening so far since the start of the year really has been that we've seen a pickup in the soft landing narrative because Europe's winter was obviously less harsh than expected, and that means that they could possibly skirt a recession. And secondly, because China's reopening has been much faster than expected as well. So that's helping the markets find a new highs right now. You know, the whole rhetoric that we had since the second half of last year about softening inflation, and add to that, you know, the receding fears of a recession. So it's becoming a very, positive cocktail for the markets. And the other most important, I think, event from last week has also been, I think, the Bank of Canada meeting, which saw the first major central bank taking a dovish turn. So they clearly said that, you know, after the 25 basis points that they did last week, that they're looking to pause for now and see how data turns out. Now, all of that is obviously leading equities push higher, but yields and dollar have been a lot more range bound. But that could potentially change this week. It's a purely event-driven week. It has a lot to offer. It has everything for something, you know, for all investors and traders really to chew on. So let's dig into kind of what's obviously key to watch this week. We have several central bank meetings from the Fed, obviously being the most important really, but also the ECB as well as the Bank of England. Lots of key data due as well from ISM surveys in the US, you know, which are obviously key to watch because they have been showing a weakening trend, and they are a kind of, you know, a very a good indicator of real activity in the economy. So whether that slowdown really continues or not will be important to watch in the survey data. We have China PMIs and the global S&P PMIs as well, which will obviously give us a good, a view of whether that soft landing narrative can continue or not. To finally the jobs report in the US and non-farm payrolls on Friday, which is again extremely important because the labor market strength is what is really helping the Fed, you know, continue its tightening path as of now. And loads of earnings as well, Amazon, Google, Apple, but we will get to that later on with Redmond. So talking about these three central bank meetings in more detail, the first one is obviously the Fed, which comes out on Wednesday or Thursday morning, early morning for Asia, 3 a.m. Singapore time. So I have already written a preview for that briefly last week, which you can find on the platform and is on the Saxo website as well. But the key message really is that there is a broad consensus, seemingly from the Fed speakers that we've heard over the last month or so, from obviously the consensus expectations as well, and also from what the market is already pricing in, that we will potentially see another downshift in that rate hike trajectory to a 25 basis points hike this week. What I'm really arguing here is that the economic data has been so volatile. I think it's really been hard to draw any kind of trends as of now. So either way, you know, to say that inflation has eased, or if you want to say that economic momentum is weakening or not, or whatever, we simply need more data to really make a concrete call. We are at pretty big turning points in terms of that data, but again, I would say it's too soon to say any thing in my sense. That just means that the Fed will potentially want to lengthen its hiking cycle, so go in smaller increments from here. It does make the most sense to me as it buys time to really assess that incoming data and also assess the impact of all the tightening that the Fed has done so far. So that's why I potentially think that they could, you know, shift to 25 basis points this week, because there is not enough motivation to go either way. So the only risk to that view is certainly the financial conditions, which have been way too easy. Now they've been they're at the easiest since March or April last year, and that's not where the Fed wants to see them. They can feed back into inflation. So that is one risk which could potentially prompt another 50 basis points before we see a move back towards 25 basis points increments. But overall, I think the market is obviously looking at 25 basis points hike this week. For the Bank of England and for the ECB, I will not cover in a lot of detail in the interest of time, but just the big highlights are that the ECB is also expected to hike rates again, but they are still expected to hike by 50 basis points. That's priced in at 86% with a 14% chance of 75 basis points still. And ECB speakers have been broadly hawkish, but even the most hawkish ones have actually only hinted at multiple 50 basis points rate hikes. So rather than another 75 basis points this week. So I think that's quite a clear case as well. But the Bank of England appears to be a little bit more split, at least in terms of market pricing. We have 70% probability of a 50 basis points and a 30% probability of a 25 basis points rate hike. But overall, how do you really use all this? How do you trade all this? So with the ECB pricing, I think way too high. We are seeing the market is pricing about 140 basis points of rate hikes until the middle of the year or so. So it's really hard, I guess, for the ECB to surprise on the hawkish side. Cannot potentially go more than that. And that could mean that euro dollar has risks to the downside this week. Overall, the US dollar appears to be having a pretty stretched bearish positioning at this time. There is some upside risk, I would say, especially if we see good US data from the ISM surveys or the labor market. There is, I think, scope for upward repricing of the Fed path from here. So the market is certainly looking more dovish than the Fed, what the Fed has been guiding for. So there is some scope for that upward repricing still if data supports, and that could bring gains back to the US dollar. But even if the data disappoints, I think the risk sentiment could get hurt quickly because we've seen that soft landing narrative pick up so much. If we see a shift back towards recession concerns or something, that could again bring the USD in favor because of the deterioration in the risk sentiment. And I do think the sterling is, of course, way overvalued, given the risks to the UK economy are potentially the highest among the developed economies. So perhaps the easiest way to go long the USD could be against the sterling. But let me just stop here now. That's taken a bit too long. And I think we'll switch over to Redmond now to talk about the other big news of the week, which is China coming back online. So yeah, it's over to you, Redmond.
Hi, morning everyone. Yes, and China is after a week-long Lunar New Year holiday, and they are back today, and so it's all eyes are watching how the market reacting. But last week we have a Hong Kong first open for 2 days, and during those 2 days, on the first day the market rally and the reaction mainly from all those rather positive news, high frequency data from China about the traveler traffic during the Lunar New Year, and also consumption data during the holiday. And so Hang Seng was up 2.9% in 2 days trading last week, and the China Enterprise Index up 3.9%, and the Hang Seng Tech is up 5.4% last week in 2 days of trading, and then it's on the consumption data over the Chinese the Lunar New Year holiday, according to the State Taxation Administration's those VAT data, and sales in consumption-related industry grow by 12.2% during the holiday, and from last year's Lunar New Year holiday, and in sales of goods increased by about 10%, and services and crime increased 13.5%, and dining in spending actually is a pent-up demand. There is a jump 53% year on year, and the strongest market actually Shanghai actually is a jump 200% in Shanghai in dining in services. And probably you also read from the news, and tourists, a lot of traveling and tourist agency sales jumped 130% year on year, and tourist hotel lodging up 16%, and budget hotel up 30%. Basically, and also movie box office also jumped to over 6.7 billion RMB. But overall, is the recovery despite those what we saw from the news about those initial outbreak of some sort wave of infection when China first exit from the zero COVID, and seems activities has been picking up quite strongly, and that is give investors some comfort, and also not only for Hong Kong and China equity market, but also on industrial metals globally, and also supporting commodities market. And so coming into this week, we will have PMI data from China, and because this PMI data cover the period of January, so given the strength and the strength in recovery during the month, and both the manufacturing PMI and the non-manufacturing PMI in China are expected to bounce strongly back to the expansionary territory. And to be specific, manufacturing PMI is expected to go to 50.1 in January, and in December it was 47, and non-manufacturing PMI was expected to bounce very sharply to 52 from last month, from December's 41.6, and mainly again because a lot of in-person service sector, which was most hit during the pandemic, and now actually is, of course, is one of the sector it has recovered very strongly, and so those data will tend to support Hong Kong and China stock market in this week. And also, we over the weekend, the China State Council also said they will continue to pledge to continue to push domestic consumption in order to support the economic growth. So consumption-related stocks and tourism-related stocks seems to be well supported into this week, and despite some of them have gone up quite a bit, but I think there's an important shift in sentiment, and instead of more and the growth sector and consumption related and stock, and the support will be able to sustain for quite a while in China. And just move on a little bit to into US, those earnings coming out from the US, and we have a very heavy earning calendar, corporate earning calendar in the US. And I mean, starting last week, you have already those heavyweight like Tesla, and the result was rather good, and so you see Tesla actually has rallied quite a lot. And American Express on Friday also reported, I mean, the earning themselves is earning miss, and have a decline, but in EPS, but because of, I think they have a rather upbeat guidance, so, and for 2023, and also an increase of dividends. So the share price of American Express did well. And then the other thing on Friday is Intel. It reported quite bad results, and the revenue came down 8% quarter on quarter, and 28% year on year, and also the EPS, non-GAAP EPS, is 47% below the analyst estimate. So, and moving on, mainly due to weakness in PC, some inventory overhang in PC market, and also server, and also the management also gave a rather downbeat guidance for this year, for the first quarter, and actually did not give any full year guidance because they said it's a lack of clarity. And then move on to this week, we will learn more about the semiconductor and chip making industry, and we will because we have AMD reporting on Tuesday, and also Qualcomm on Thursday. And market basically is expecting both of these company on the back of those headwind in the semicon industry, and also the poor result from Intel, expecting around 27% year-on-year decline in EPS on both cases. And in fact, is basically is many of those the expectation for earnings for this week is actually the bar is quite low, and for we have a lot of earnings announcement from the consumer industry, discretionary consumption industry, and I'm not going to read them all, but it's like General Motors, McDonald's, Ford, Starbucks, that are the important one. And the most important one, of course, is Amazon. Amazon is the market consensus is calling for 88% decline in as fourth quarter EPS to 17 cents. So again, the expectation is rather low. And another company you probably would like to monitor is UPS, and I think the outlook, the comments on the global economic activities will be very important and to watch. And then the heavyweight this week, as Charu mentioned, is the three mega cap company, Meta and Alphabet and Apple. And the consensus estimates for are expecting decline in EPS in all three of them, and for Meta, and consensus expecting EPS to decline by 40% to $2.22, and Alphabet is analysts expecting it EPS to decline 22% to $1.20. And Apple did a little bit better, but it's still a decline of 7%, being expected to $1.95. And despite those rather downbeat estimate, in fact, up to last Friday, out of those 143 companies already reported in the S&P 500, and that's about 29% of the constituent stock in the S&P 500, and 41% of them actually beat the analyst estimates, and around 40% in line. So if on a market cap weighted basis, is 38% of those have reported as a bit analyst estimate. So the result from those have already reported actually less bad than fear. So let's see whether this week whether that will also those companies can report a result better than the low expectation. And I think that is I think that we have covered most of we would like to talk about for today. And Charu, do you have anything to add?
I think just very briefly, maybe what to watch for in commodities. I think so. Focus this year so far has been on industrial metals because of China's reopening, so that will remain in play this week as well, with China coming back online. But also watch for prices of agricultural commodities. Geopolitical tensions are picking up again, and there are supply risks, which are becoming a lot more pronounced as well. So wheat prices and even rice prices could be key to watch this week. Thai rice prices are moving to 2-year highs, so especially key for Asia, which is of course a key rice consumer, and how that plays into inflation expectations in Asia and globally. I think so important to watch that. But yes, I think Redmond, I think we'll just stop here. That will be it from us for today. Thank you for tuning in, and have a good day, good week, everyone.
Thank you.